All right, UnitedHealth stock is trading near its 52-week low, and I know a lot of you are considering buying this stock. Also, I know a lot of you that have owned UnitedHealth stock all the way down here are now thinking about selling. But before you do any of that, buying or selling UnitedHealth stock, you need to know the things I'm going to discuss in this video here so you can make a more informed decision. I'm going to share with you these latest developments and what it can mean for UnitedHealth stock investors. Let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the management team in their second quarter 2025 conference call with Wall Street analysts said that in Medicaid, there remains a lag between funding levels and member health risk, and we expect this to continue into 2026. So this is not only a 2025 problem for United Health, it's probably going to be a 2026 problem as well. So this is going to result in additional margin compression in the business. And what that means is that profit margins are going to continue shrinking, including a loss within the non-dual segment of Medicaid in 2026. Membership losses from early adoption of recent legislation is also factored into our initial views for 2026. Several headwinds here impacting United Health Group stock investors and causing their profit margins to shrink. As a result, what I've done is I've lowered my free cash flow expectations for United Health Group stock over the next several years. So the company continues to feel that value-based care remains the most effective method for compensating providers to improve and sustain a patient's health, in contrast to simply increasing the volume and price of services. And I agree with this for the most part, and just for overall health outcomes and the way people feel, value based care, which means taking care of people and earlier, more effectively before these problems surface and expand into more difficult to treat diseases and painful situations for individuals. If United Health can help encourage providers to see patients earlier, more frequently, before things become more severe, then that lowers the cost to serve those patients because it's easier to serve patients early on when they see something that's not quite right, offer a remedy earlier in this process. That will lead to better outcomes because people's health won't worsen and then need to have some really invasive treatment to try and bring someone's health back to normal levels. And of course, it's better for the individuals as well to have something treated before it gets worse, before you start to see more negative outcomes, before you start to experience more pain. It's better to have something spotted earlier and get it treated earlier before it becomes a bigger problem. So the company said that Optum Health, which is one of the segments in its business, the earnings in that segment in 2025 are approximately $6.6 billion below their expectations. $6.6 billion below their expectations for earnings in 2025. That's huge. So to break it down, approximately 3.6 billion is concentrated in their value-based care business. So that's the bigger segment where the company is experiencing more of the losses. But the company's management also said that the longer patients are in the value-based care system, the more profitable they become over time because those treatments early on, while it may cost more to treat them earlier because they're visiting doctors' offices before they feel the need to, maybe, and they're visiting more frequently before something hurts a lot or something obvious is wrong with them. But at the same time, if they stay with these treatments longer term, they become more profitable because it prevents certain problems later on down the road. And the company gave a nice breakdown of the cohorts between when someone started in 2020 and 2021 and 2022 and 2023. And they highlighted how patients who started earlier in this system are now becoming more profitable, whereas the more recent patients are less profitable. And so over time, the company expects this headwind will improve as patients stay in the system longer term. So the headwinds are noticeable for the company, and I've talked a lot about that And so those have been reflected in the company's valuation. So this chart I'm getting from fiscal.ai, which is my preferred data destination. Can get a link for the in the description for a discount to their services. The forward price to earnings ratio, which is the chart that I have pulled up here, UnitedHealth stock is trading at a forward PE of 12.73. This is the lowest by far this stock has traded for, going all the way back to January of 2021. In fact, between January of 2021 and January of 2024, this stock traded at a forward price to earnings ratio between 18 and 24. So these headwinds have the stock trading at a forward price to earnings of 13, which is a lot lower than the average of 21 this stock was trading for between 2021 and 2023. So while the headwinds are significant, I feel they are reflected in the company's valuation. Additionally, I've incorporated the headwinds into my proprietary discounted cash flow valuation for UnitedHealth stock, and I still calculate an undervalued stock where the fair value, where I feel a fair price to pay for this stock, is $437. The current market price is $241. So whether I'm looking at the forward PE or the proprietary model I created to calculate the fair value, it still looks undervalued, but the headwinds are significant to be sure. So the company, on lower service volumes in 2025, planned for approximately 20 million fee-for-service visits in their care delivery clinics, and they were tracking 19 million visits, or about 5% below this expectation. So for 2025, they were forecasting about 20 million visits to their locations where they get a fee for the service, and they're actually seeing only 19 million visits. Or now they're actually forecasting only 19 million visits. So 5% below that expectation. And this is one of among many miscalculations that the company made for 2025, as well as miscalculating the amount of cost they were going to experience in another segment. So they were all over the place in terms of their forecast for 2025. They were off significantly, and that's creating significant headwinds in the business overall because of these miscalculations. This document I'm reading from is the Q2 2025 conference call transcript. I've made this available for my channel members. You can see this in the membership benefits section on my YouTube channel page. If you're not a member yet, you can join for less than $5 per month. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.